This is a demonstration of problem 431, compute and interpret liquidity, solvency, and coverage ratios. Information from the balance sheet, income statement, and statement of cash flows for Nike follows. Refer to these financial statements to answer the requirements. In Part A, it asks us to compute the current ratio and quick ratio for 2018 and 2019 and comment on any observed trends. So I have computed for 2019 and 2018 the current ratio, which is current assets divided by current liabilities. I've also computed the quick ratio. The quick ratio is more stringent. So in the numerator we have cash and equivalents plus short-term investments and accounts receivables divided by current liabilities, and these are the two quick ratios. So when we look at the liquidity ratios, which are the current and the quick ratio, we see that the current ratio decreased just slightly in 2019, and so did the quick ratio. Although these both have declined, they're still very strong ratings, and the company is liquid and can meet its short-term obligations. The B part states compute total liabilities to equity ratio and total debt to equity ratio for 2018 and 2019 and comment on any trends observed. So first we're going to compute the total liabilities to equity, and we have those two ratios, and then we compute total debt to equity, which is the current portion of long-term debt plus notes payable plus the long-term debt divided by equity. And we notice our total liabilities to equity has gone up, and our total debt to equity, though, has slightly, very slightly decreased. So although the total liabilities to equity did increase, which makes the company slightly more risky, they still have a debt to equity ratio that's pretty much the same, and overall both of these ratios are within the acceptable level, so Nike appears to be solvent. In Part C, it asks us to compute times interest earned ratio, cash from operations to total debt ratio, and free operating cash flow to total debt ratio. It also gives us some information from the financial statements footnote. It states that included in interest expense income net was interest income related to the company's investment portfolio of $82 million and $70 million for the years ended May 31st, 2019 and 2018. So we have to use that information when we compute the ratios. The first ratio is times interest earned. Times interest earned is going to be equal to the gross profit on the income statement minus the selling and administrative expense, and we're going to divide that by the interest expense plus that interest income that they gave us in the footnote. So we got our information from the gross profit and the selling and administrative expense, subtract those, and then we took our interest expense and we're going to add back that interest income, and we got our times interest earned for 19 and 18. Next we have our cash from operations to total debt, and we've got those ratios for 18 and 19, and then free operating cash flow, which is equal to operating cash flow minus capex and then divided by total debt. So let's look at the coverage ratios. We see that times interest earned has gone up slightly, and that is good. That indicates that we are able to meet our interest payments as they come due. Our cash from operations to total debt and free operating cash flow to total debt have also gone up, so that means that it's easier now for us to also pay our principal payments. So all of Nike's coverage ratios increased in 2019. They're very strong ratios, so it indicates that the company has no problem covering their interest and principal repayments. In D, it asks us to summarize the findings in a conclusion about the company's credit risk. Are there any concerns about the company's ability to meet its debt obligations? We saw from the liquidity ratios, the solvency ratios, and the coverage ratios are all strong, and the company poses very little credit risk. However, with any company, maintaining that cash flow from operations is important because that is what you need to have in order to be able to pay your debt. And Nike, like many other companies, has been repurchasing a lot of its own stock and making large dividends. So you have to keep enough money coming in if you're going to buy treasury stock and make large dividend payments so that you can also service your debt. But right now it doesn't appear that Nike is in any danger of or poses a great credit risk. And that is the end of the demonstration for problem 431.